Shvets now to discuss the global cues. He's from Macquarie. Viktor, good morning. You think once again this whole UK election uncertainty being out of the way now, do you get a sense that global markets are set to start a fresh round of rally? We saw that in European markets on Friday, though emerging markets are a bit weak today.
Well, I don't think it should make much difference. I mean, we live in a world where unexpected electoral outcomes is part of the course. It's not an exception. That's why we have novices being elected in France. That's why we have amateurs in Washington. That's why we have President Duterte in the Philippines. That's why we have President Erdogan in Turkey. So none of those electoral outcomes actually should come as a surprise. Now, if that is the case, then you have to argue that there are other things that are supporting financial assets. And from my perspective, what's supporting financial assets is a global liquidity. Central banks are still pumping $1.5 to $2 trillion every year into financial system. And so long as that continues, and so long as we have to continue leveraging, financial assets cannot be allowed to derate in any meaningful way.
Fair point. Morning, Viktor. You really make our morning with your sense of humor. But, you know, I read your latest note, and it's about this cost of capital showing no signs of rising. In fact, cost of capital showing signs of falling. While that certainly makes sense across, and you're speaking about how, therefore, in all countries, governments will actually ladle out largesse, will that be true of emerging countries like India, where, you know, we are still chasing inflation targeting and lower fiscal deficit so as to improve our rating?
Yeah, I mean, you're absolutely right. There are differences between the countries. What you can say and what you can argue, I think, is that cost of capital can never go up as we go forward, ever. In fact, cost of capital globally probably will go negative as we go forward. But there are countries which still have productivity gains. There are countries where there are still some real bottlenecks. Now, those countries could have a somewhat different perspective. So from my view, whether you're in India, whether you're in the US, whether you're in France, whether you're in Japan, it doesn't matter. Over the longer term, cost of capital will go down. But in the shorter term, you would still have bumps in emerging markets like India, whereby cost of capital could go up before it goes down again. Right now, it seemed to me that deflationary pressures are rising again. Disinflation gets stronger, and so I think cost of capital actually in the short term will go down, not up in India.
Okay, that's interesting. Viktor, good morning. The next event that everyone's watching is the US two-day FOMC meeting that begins tomorrow. Are you expecting a rate hike as well this time around? And do you think it could cause some jitters in global markets, or is the liquidity too strong for any kind of roiling?
It's completely irrelevant. And so my perspective, the way I look at it, the more they tighten, the more yield curve flattens. And if they continue to insist on tightening, eventually it might inverse, in which case they will have to cut rates again in order to support the process. So from my perspective, Federal Reserve and most central banks are still looking at the faulty models that are very much based around labor market and labor market slack. My view for quite some time was that labor is completely irrelevant. Human input is declining so rapidly that labor markets really tell you nothing. So from my perspective, I think they're looking at the wrong areas. I think there is a huge case to be made that cost of capital should be negative. And it should be negative simply because we must produce more capital for the capital's sake. We must produce more capital to avoid financial assets collapsing, and then those collapse of assets impacting real economies.
Okay. Well, Viktor, a final question to you. Your note also says that the cost of capital and the returns on capital and labor will be lower, but the return on knowledge will be higher. Let me keep that also on board. Two questions. What would be, therefore, your allocation of funds between assets and your allocation for equities within markets?
Well, what we basically argued on a global basis that we prefer to have allocation towards thematics. So in other words, if we live in a world where humans mean less and less, and if we live in a world where capital is disintegrating and actually will be worthless over a period of time, we're essentially joining the other side. We're joining the fight for destruction of labor and destruction of capital. So the areas we particularly look at are what we call poison of the people or opium of the people, which is things like entertainment, games, artificial reality, gambling. We also invest into replacement of humans, which is robotics, automation. We invest in biotech, particularly augmentation and sequencing of genome. We invest in global dislocation. That's why we're buying weapon manufacturers and drone manufacturers. We invest in disruptors. So in other words, it's a very dystopian, disruptive asset allocation that we're making. When we look at the shorter term in terms of countries, we're trying to steer the middle course. So in other words, what we're saying in the short term, things won't get too bad or too good. Now, in the middle are countries like India and the Philippines. But that remains our biggest country positioning.
Okay. Thank you very much, Viktor Shvets, for speaking to us on a bunch of issues, and that too